So here's a quick lesson in buying assets. Now, everybody knows you get capital appreciation over time, and everybody knows you get rent, which either pays off the interest, so you get a Brucey bonus, or it pays off the capital and the interest. So you end up with the asset at the end of it. Now, the other thing to get your head around, which can be a little bit difficult, is over time, as the currency is devalued and as inflation takes a grip of the economy, your debt actually decreases and it shrinks. Now, it doesn't shrink in the amount of money. So say you take out a £75,000 mortgage on a house, it doesn't go to £65,000, but it shrinks in proportion to the overall economy. So as the house appreciates, the debt stays the same. So if you imagine when you first take the mortgage out, say it's 75% loan to value of the overall house of £100,000, the debt is then stuck at £75,000. So that house could go to £250,000, £1 million. You still only owe £75,000 on it. So can you see how the debt doesn't shrink in monetary value, but because it's a fixed percentage of the purchase price and not the overall value of the asset, it diminishes over time as the economy goes up over. So as the currency decreases and as inflation rises, your debt on any assets decreases. So if you imagine, say, everybody's seen them houses years ago. God, look at this house. It's just down the road. It was £26,000 for £260,000 today. Well, imagine having £5,000 worth of debt on that house and it's worth £260,000, because you see how the debt is a fixed monetary figure and not a percentage of the asset. Because if it was a percentage of the asset and it moved with the capital appreciation, the bank would then want a percentage, the 75% of the sale price when you come to sell it, and it would move up with as the asset appreciates. So it's a good thing to get debt, and really, as long as you're buying smartly, the quicker you get debt, the faster it starts to depreciate, basically diminish. If you think of it, as minimum wage rises or as rents rise as well, your ability then to pay down that debt increases. So where, let's say, for example, it's £500,000 house and the rent's £500, that's a lot of months of rent to pay down that debt, isn't it? Now, what if the rent was £5,000? What if it ends up being 50 grand, but the debt was took out many years ago? Your ability to pay that has increased. The same with as minimum wage rises, you need less hours at work to make the monthly payments to pay off the debt. Obviously, as interest rates rise, it kind of scuppers that plan, but that's the best way at looking at how your debt decreases, because it's a fixed monetary value on the